Hi there. Hi, good day and welcome to the channel. So today I didn't really make notes, but I want to talk briefly about valuing a share or a stock. So yeah, just to give you a little bit of insight into what to look for and what to look out for. Okay, wonderful. So let's get into this. And if you can please like and subscribe to my channel and follow me for more on finance and the stock market, anything to do with finance. Thank you. Okay, so if you look at any share that's listed on the stock exchange, it has what they call a price earnings ratio. So it's the price to earnings. So now obviously how it works is they take the price and then divided by the previous earnings. So it's a historical, okay? So now you might hear sometimes they talk about a forward PE. So what they're talking about is when they talk about a forward PE, they take the current price and compare it to the future earnings. But obviously, until they bring out them earnings, then it doesn't really help. But it does help. For example, if you look at a share like Nvidia, the current PE is about 54. 54, and the forward PE is plus minus 30. So obviously, after they bring out the year-end results to the end of January, which will be out in February, then they'll be able to then adjust the PE there. So obviously, if they do keep to earnings, or they surpass their earnings, which I'm actually pretty sure they are going to do, then obviously that PE will be obviously way too low, and the share price obviously needs to then rise quite considerably to equate. So in other words, if it stays, for it to stay on a 54, 55 or whatever PE, the price is going to have to rise quite a bit. Okay, oopsie. So your price to earnings. So in other words, if your price goes up, then your price to earnings ratio goes up. Okay. So in other words, if you have, like for example, let's look at Palantir. Palantir was on a crazy PE. It still is. It was on something like a 350 PE, and then we had quite a nice rise in the price, and the PE went up to close to 400. So in other words, the stock is 400 times the previous earnings. Now, for that, either the earnings has to catch up to the price, or the price must come down to the earnings. So Palantir did have a bit of a drop down to about 70. It seems to be picking up. For me, from a valuation point of view, and this is a disclaimer, I'm not a financial advisor, so don't take this as financial advice. When the price rose up to 80, it was 81 and a half or something, then I was actually looking to sell. I actually sold out. And then if you sell out of a share, don't worry about the price afterwards. If the price goes up, if the price goes down, it doesn't matter, because you don't own it anymore. Okay, so it's not like you're married to it. So for example, if I'd have sold it 81 and a half or 80, whatever I sold at, say for example, if the price went up to 90 or 100, which it might very well do in the future, don't kick yourself for saying, oh, I sold, now it's going up, I'm losing out. You're not losing out anything, because if you sell out of that one, then you buy into another share, maybe with better prospects of an increase in the price. I'm not saying Palantir's got excellent prospects, but I think the share, in my opinion, and like I say, I'm not a financial advisor, so don't take this, but in my opinion, the price had run way too high. I mean, it came from something like $20 or something. So yeah, so in other words, so that's what you look at with a PE ratio. And you've got a PE ratio of a share, you've got a PE ratio of an individual shares, you've got a PE ratio of the stock market as a whole, and you've got PE ratio for that sector. So in other words, say for example, the tech sector will be a higher PE than the market. The S&P is about 20, probably about 27, around about 27. Like I say, Nvidia was at 50, around about 55, 54, 55. So obviously Nvidia is higher. So what they say is people are paying, if it's over the market, then you're paying a premium for the price, which is current and future earnings, obviously. So even though it's overpriced value to the index, to me it looks like a very good price if you look at the future prospects. So always look at what's, and obviously the future is never certain, but if a company's growing like that and the cash flow is incredible, then they will keep on doing that. This growth will slow down in the future, but I mean we're talking about slowing down from 100% to maybe like 80% or something. So the other things, there's also something called the earnings yield. Now, earnings yield is the opposite of price to earnings ratio. So in other words, that's earnings over price. So in other words, it's a direct inverse. So they used to work with the earnings yield, but I see they don't really work with it anymore. You used to hear it a long time ago, but it's basically inverse. So in other words, if the PE is 5, then the earnings yield will be 20, if my math is right. Okay, so basically, and in other words, if the price goes up, the PE goes up, and if the price goes up, the earnings yield goes down. So that's how that works. Okay, then you get the dividend yield, which is the previous dividend compared to the current share price. So you take that dividend yield. It can be 1, it can be less than 1, it can be 2, 3, 4, 5, 10%, 20%, 30%. Okay, so what your dividend, each company, some don't pay dividends, they reinvest into the company, some pay dividends. When they pay out a dividend, then they're paying it out of the profits. So in other words, they come up with their earnings, be it quarterly earnings, and then some companies pay once a year, some companies pay twice a year, some companies pay 4 times a year. Every quarter they pay a dividend. But they take the dividends for the year, and then they take that yearly dividend, and then they work out the dividend yield on that. So in other words, if a company has a dividend yield of 4 or 5%, then you're going to get 4 or 5% each year on that as a dividend. Most companies increase the dividend. Also, the price goes up, but they increase the dividend. If they can increase the dividend by double digits over a period of 10, 20 years, and there are companies who do that. For example, Visa is on quite a low dividend yield. I think it's something like 0.8%. But they're generating huge cash, and they're paying a regular dividend, which has been increasing for decades and decades, and it more than likely will continue to rise like that. So in other words, even though your starting dividend is low, that dividend, if you buy now today, the dividend you'll get will increase every year. So that's a worthwhile dividend. And the problem is, if you look at buying a dividend that's too high, for example, you would say, let me look, Visa is 0.8. No, I can't buy that. Let me look at another. Here's a stock here, and this one is like 11, 15%. Oh wow, 15%. Wow, that's obviously there's a no-brainer. You must buy the 15%. No, it's what sometimes they call it a dividend trap. So in other words, that 15% is not sustainable. In other words, the company doesn't have the future cash flow to pay that high dividend. And then sometimes, obviously, like I said, that it's dividend over the current share price. Sometimes, if the share price falls a lot, then obviously, if the dividend stays the same but the share price falls, then the dividend yield goes up. So in other words, you're trading a higher dividend for a dropping share price. So in other words, that's not what I look for. I don't know about you guys, but I don't look for like that. Um, I always be wary of a, of a company that's paying very high dividend and see why. Have a look at the previous dividends it's paid out. See if it's been paying. There's another company. Well, there's quite a few companies, but like for example, I was looking at J.P. Morgan in the US, and I actually looked back at the dividends over the years, and that dividend has been increasing every single year. They pay 4 times, they pay quarterly, and that dividend has been increasing every single year. And yeah, it's not a stock I own at the moment, but I definitely must look into that, getting some of them shares in the future. So yeah, but like I said about fear of missing out, I was talking earlier about Palantir that went up so much. There actually is a saying for it. It's called FOMO, which is fear of missing out. And you've got to have actually the mentality to say, you look at and you make a decision to buy, you make a decision to sell. After you've made that decision, don't kick yourself or don't congratulate yourself as well. Okay, because for example, you might buy and then the share price goes up 5%. Then you're like, oh wow, made a great investment, 5% up, great, that's fantastic. Yeah, it's fantastic for now, but for example, that share could go up 5% and then it could drop 95%. You know what I mean? So don't congratulate yourself too early, okay? And conversely, if if you buy and the share price drops 5%, oh no, that was a terrible investment, you know? If you look at the fundamentals and you see, okay, yeah, there's a reason why it went down, then you can sell. There's nothing stopping you from selling, and there's nothing stopping you from buying more. If you see it's a very attractive investment and it's fallen, then you can buy more. You can buy more and then average your price a bit lower. But yeah, also the other thing is, for example, I've actually done it before as well myself. I've actually bought a share for whatever reason and sometimes sold it later, sometimes at a profit, whatever. But I've actually bought the share and sold it. Let's say the price has risen a bit, and for whatever reason, I decide to sell that share. Then after I sell the share, the price goes up a bit more. Then, for example, you can't say, oh, well, I bought it at that price, I sold it at that price. So bought it at 40, sold it at 50. So I can't buy it at 60. But the answer is no, that's not right. You can actually buy it at 60. If you buy it at 40, sell it at 50, you've made a profit. If you buy it at 60 and then sell it higher later on, then you've made a profit as well. Okay, and look, I'm not actually advising trading shares. I have done a little bit of trading, but I was actually building up a portfolio. So I have been trading a little bit here and there, and but what I'm actually doing is building up a portfolio, mainly dividend paying, and obviously growth shares, and a nice split of shares plus some ETFs, building that up over time. So I actually think the best thing to do is actually to I've got nothing against trading. I know there's a lot of guys who trade, but it's short-term movements and it's very high pressure, sort of, especially if the stock goes in the wrong way, which is sometimes the case. So trading is definitely not for me. I rather buy the shares, buy good companies at good prices, or fair company at an excellent price, and then just forget about it basically, and just in a few years' time, that the price should have risen because of the prospects. If prospects change, then you can always say, okay, I can sell out and sometimes make a profit, sometimes make a loss. But and the other thing is as well, if a share price went down, If you, some people put like a stop loss, especially traders. Some people put a stop loss because they can't, if they lose 5% or 10%, then it's like, it's the end of the world. But for me, you should, if you're buying shares, you should be able to handle a 20 to 25% loss in the share. Because, for example, the share price might fall 20 to 25%, and then it will obviously pick up again. And then also, you also do have the option of buying more at the lower price. So in other words, if you know a company is really doing well and the stock price falls, which it does sometimes, I can think of a few that's actually fallen. There's no reason for it fundamentally, but then you just hold on and wait, and then obviously you can buy more shares at the lower price. Obviously don't rush into it, but sort of slowly accumulate, buy a bit, and then wait a few days, and then okay, buy a bit more, wait a few days, see where it's going. But the thing is, it's not a race. It's a slow. They say the boring it is, the better. So in other words, be boring. Be boring. Buy good companies at hopefully good prices or excellent prices, and then go along for the ride. You should be able to manage a big thing, and then if you can't handle the big losses and stuff in the short term, then what you can do is buy more ETFs and have a lower percentage in individual shares. In other words, your ETFs are obviously made up of a lot of companies. So in other words, one company can do well, one can do badly, and they sort of balance each other out. So you haven't got all your eggs in one basket, which is a popular saying. If you've got one share, then obviously all your eggs are in one basket. If you've got 20 shares, then obviously you're spreading your risk out over them shares. But hopefully then all 20 go up dramatically, and let's see. Prospects for the year. If you listen to these guys, the one says the stock market is going to rise, the next is going to say we're going to have a pullback, but you look at the fundamentals. Look, interest rates are coming down. They say there might be some, especially in the US, some inflationary stuff coming in with some new policies that the new president's going to bring in. So we'll see what they bring out. That might affect interest rates slightly. In other words, the interest rates might not come down as much as we originally hoped in the US. In South Africa, our interest rates, we at the beginning of the interest rate cycle, we've had two times 25% decreases. I think in 2025 we should get quite a bit more. Our inflation came in at 2.9 as opposed to 2.9 as opposed to 2.8, which is underneath the 3.1 inflation, and they are talking about revising that up a little bit from 3.1 because usually in general our inflation is higher. So we've come from a double-digit inflation, in the 90s and the and that. So our inflation has dropped a lot lower. So I think there's a lot of room for interest rates to come down in South Africa. So let's hope. Let's see how it goes. Lower interest rates usually mean a better stock market because there's more incentive to invest in the stock market if the interest rates are lower, because if you're looking to invest in fixed interest or the stock market, as the fixed interest rates come down, you're getting less and less money for your fixed interest, then obviously the stock market will go up. Also, we've got things like load shedding is finished, hopefully. So with the we had something like 200 and something days of no load shedding. So hopefully that continues, no load shedding. And also with the two-pot system, people have access to some of the funds, a tiny portion of their funds without having to resign. So that brings some money into the economy. You know, they said they were looking between 50 and 100 billion, probably for the first year. So well, let's see. I think we're probably about, I think, 20 billion or so, 20 to 30 billion so far. So yeah, so let's see. So yeah, you know, you've got the government of national unity. So there's a lot of positives on South Africa, and I see our rand increased in value. So now the rand increasing in value is obviously good for some and bad for others. It actually helps to keep our petrol price lower, because we work on the rand price of oil. So that obviously helps for that. But also, if you've got investments like in the American stock market and that, then obviously a stronger rand is actually like bad for that. So obviously you've got your increase in stock prices, and your rand. If your rand weakens, then you're making more money. Yeah, so now is actually a good time to buy, because the rand is stronger. So you're getting a little bit of a better price when you compare it to when the rand is a bit weaker. And then over time, usually the rand will weaken, not much, but I mean, you know, like probably 5% or maybe 2% a year, to the dollar. So yeah. So I think there's a lot of positives for South Africa. We're sitting on a PE ratio. That South Africa as a whole market, we're sitting on a PE ratio of about 12 at the moment, 12.5, I think. So our PE ratio is 12.5. The S&P 500 is sitting at 27. So you can see the difference there. So I think our South African market is very good to invest in as well. And then obviously for people overseas, the Americans, and that investing in our market, obviously the rand dollar is obviously the inverse for them. Okay, so yeah. So obviously if the rand weakens, then it's more incentive for them to invest here. Yeah. So that's a little bit of PEs and stuff, and a little bit of looking at the economy and looking at everything in the meantime. Like I'm saying, I'm not an economist, I'm not a financial advisor, so this is a disclaimer. Don't take it as financial advice. But I hope you find some of this informative, and yeah, I look forward to doing the next video. And then if you got any comments, if you would like me to speak about anything in particular, then please just let me know, and like and subscribe. Thank you.